In 1397, a small bank opened in Florence, Italy. It had 2 employees and capital of 10,000 florins, about $200,000 today. Within 50 years, this bank controlled the finances of 4 popes, 7 kings, and every major merchant in Europe. It didn't just lend money. It invented double-entry bookkeeping, letters of credit, holding companies, and fractional reserve banking. Every financial instrument you use today, credit cards, bank transfers, corporate accounting, they all trace back to this one institution. The bank was the Medici Bank, and the family that ran it didn't just get rich. They became popes, queens, and political powers for 300 years. But here's what matters for you right now in 2025. The Medici Banking Formula never died. It evolved. The structures they invented, the accounting methods they pioneered, the financial engineering they perfected, it's all still being used. JP Morgan Chase uses Medici accounting structures. The Federal Reserve uses Medici credit creation methods. Every modern bank operates on principles the Medici established in the 1400s. Understanding the Medici formula isn't history. It's understanding how your bank account actually works, how credit is created, and why banking crises follow the same pattern they did 600 years ago. Let me show you exactly what the Medici built and why it still controls your financial life. Giovanni di Medici founded the Medici Bank in 1397. He wasn't born wealthy. He wasn't nobility. He was a minor merchant son who worked his way up through Florence's banking system. But Giovanni understood something that would change finance forever. Money doesn't need to exist to be useful. You can create value through accounting, through documentation, through promises. This sounds abstract. It's not. It's the foundation of modern banking, and the Medici perfected it. Before the Medici, banking was simple. You deposited gold. The bank held your gold. You withdrew your gold. Banks were warehouses for metal. They charged fees for storage and security. They made profit from fees, not from the money itself. Some banks lent money, but lending was limited by how much actual metal they had in the vault. If a bank had 1,000 gold coins, they could lend 1,000 gold coins. Simple, limited, unprofitable at scale. Giovanni saw the inefficiency. Why does money need to be metal? Why can't money be a promise? A documented agreement that value exists and can be transferred. If 10 merchants each deposit 100 gold coins, that's 1,000 coins total. But those merchants don't all withdraw at once. Most of the time, 800 coins just sit in the vault doing nothing. What if the bank lent out those 800 coins while keeping 200 in reserve for withdrawals? The bank could charge interest on 800 coins while only having 1,000 coins in deposits. That's an 80% return on money that's technically not yours. This is fractional reserve banking. And Giovanni didn't invent it, but he systematized it. The Medici Bank operated on approximately a 10-to-1 ratio. For every 10 florins in deposits, they kept 1 florin in reserve and lent out 9. This meant they were earning interest on 9 times their actual capital. The profit margin was extraordinary. But it only worked if depositors trusted the bank. If everyone tried to withdraw simultaneously, the bank would collapse. So trust became the product. The Medici didn't just manage money, they managed reputation. Giovanni built trust through meticulous record-keeping. The Medici Bank pioneered double-entry bookkeeping in banking. Every transaction recorded twice, once as a debit, once as a credit. This wasn't just accounting. It was proof. If you deposited 100 florins, the Medici ledger showed your account credited 100. And the bank's vault debited 100. The books always balanced. This created verifiable trust. You could audit the accounts. You could see your money existed, at least on paper. Double-entry bookkeeping is so fundamental to modern finance that we forget it was invented. Every company, every bank, every government uses double-entry accounting. Assets equal liabilities plus equity. This equation, this structure. It came from the Medici Bank, and it enabled something revolutionary: the creation of money through accounting. Here's how it worked. A merchant in Florence wanted to buy wool from England, but transporting gold across Europe was dangerous. Bandits, pirates, corrupt officials. The risk was enormous. So the Medici created a solution: the letter of credit. The merchant deposits 1,000 florins with the Medici Bank in Florence. The bank gives him a letter of credit, a document stating the Medici Bank in London will pay 1,000 florins worth of English pounds to whoever presents this letter. The merchant travels to England with just a piece of paper. He buys wool. He presents the letter to the Medici Bank in London. They pay the wool merchant in local currency. The transaction is complete. No gold crossed borders. No physical money moved. The Medici Bank in Florence debited the merchant's account. The Medici Bank in London credited the wool merchant's account. The books balanced. But here's the key. The Medici Bank in London didn't have 1,000 florins sent from Florence. They just had a ledger entry saying Florence owed London 1,000 florins. And most of the time, a merchant in London would simultaneously be sending money to Florence. So the debts canceled out. The Medici Bank in Florence owed London 1,000 florins. The Medici Bank in London owed Florence 800 florins. Net transfer, 200 florins. But the bank facilitated 1,800 florins worth of commerce. They charged fees on both transactions. They earned interest on money that mostly existed as ledger entries. This is how modern banking works. When you wire money from Chase in New York to Chase in London, no physical currency moves. It's accounting. Chase in New York debits your account. Chase in London credits the recipient. The books balance. The bank profits from fees. The Medici invented this 600 years ago. But the Medici's true innovation was the holding company structure. Giovanni's son Cosimo de' Medici took over the bank in 1434. Cosimo was a financial genius who understood risk. If the Medici Bank was one entity and one branch failed, the entire bank could collapse. So Cosimo restructured the bank into a holding company with semi-independent branches. The Medici Bank wasn't a single bank. It was a parent company that owned shares in separate branch banks. Florence, Rome, Venice, Milan, Geneva, Lyon, London, Bruges. Each was a separate partnership. The parent company owned 50 to 70% of each branch. Local managers owned the rest. This structure did three things. First, it limited liability. If the London branch failed, it didn't bankrupt the Florence branch. The losses were contained. Second, it incentivized managers. Local managers had equity in their branch. They profited directly from their branch's success. This aligned incentives. Third, it made the bank too complex to regulate. Each branch was technically a separate entity. Governments couldn't easily seize or... This is the exact structure modern banks use. J.P. Morgan Chase isn't one bank. It's a holding company called J.P. Morgan Chase & Co. that owns subsidiaries. Chase Bank, USA, J.P. Morgan Securities, J.P. Morgan Chase Bank, NA, and dozens of others. Each subsidiary is legally separate. If one fails, theoretically, it doesn't take down the parent. This structure was pioneered by Cosimo de' Medici in the 1430s. The Medici Bank grew explosively under Cosimo. By 1450, they were the largest bank in Europe. They held accounts for the Pope, the King of France, the Duke of Milan, and virtually every major merchant. But the Medici understood something other banks didn't. Banking is about relationships, not transactions. Cosimo didn't just lend money to kings, he became indispensable to them. He managed their finances, arranged their loans, facilitated their payments. Kings couldn't function without the Medici. This gave Cosimo political power that exceeded his wealth. When the Pope needed to collect taxes from across Europe, the Medici Bank handled it. When kings needed to pay armies in foreign territories, the Medici transferred funds. When merchants needed currency exchange, the Medici set the rates. The bank became the financial infrastructure of Europe, and the Medici collected fees on every transaction. The profit wasn't in lending, it was in facilitating. This is how modern financial institutions make money. Banks profit more from fees than from interest. Transaction fees, service fees, transfer fees, overdraft fees. Chase Bank makes billions annually from fees. So does Bank of America. The Medici pioneered this model. Make yourself essential to every transaction. Charge small fees on enormous volume. The profit compounds. By 1464, when Cosimo died, the Medici Bank had branches in 12 cities. Assets worth over 200,000 florins, approximately $50 million today, and relationships with every major power in Europe. Cosimo had also used banking profits to buy political control of Florence. He never held official office, but he controlled who did. The Medici became the de facto rulers of Florence through financial leverage. This pattern repeats throughout history. Financial power converts to political power. The Medici proved it. The Rothschilds would repeat it 400 years later. Goldman Sachs and JPMorgan do it today. But the Medici Bank's peak was also the beginning of its decline. And the reasons for decline reveal something critical about banking that's true today. Cosimo's successors, Piero and Lorenzo the Magnificent, were less competent bankers. They made bad loans. They lent to rulers who couldn't repay. They expanded branches into unstable markets. By 1494, the Medici Bank was collapsing. The London branch failed. The Lyon branch failed. Bad debts in Naples and Rome couldn't be collected. The holding company structure that protected against isolated failures couldn't protect against systemic incompetence. When multiple branches fail simultaneously, the whole structure collapses. This is exactly what happened in 2008. Lehman Brothers, Bear Stearns, Washington Mutual, all had holding company structures. All had subsidiaries. But when the mortgage crisis hit multiple divisions simultaneously, the structure didn't protect them. The Medici Bank failed the same way modern banks fail, through over-leveraging, bad lending, and systemic risk. By 1494, the Medici Bank was effectively bankrupt. The family was exiled from Florence. But here's what matters. The banking methods survived. The double-entry bookkeeping, the letters of credit, the holding company structure, the fractional reserve system, all of it spread across Europe. Other banks copied the Medici model. And the model evolved into modern banking. The Medici family returned to power in Florence by 1512. They produced 2 popes, married into French royalty, and remained influential until the 1700s. But their banking empire was gone. The methods, however, became permanent. Every bank today uses double-entry accounting. The structure the Medici systematized is now global standard. When you check your bank balance, you're looking at double-entry ledgers. When you transfer money internationally, you're using letters of credit conceptually identical to what the Medici created. The mechanics are digital, but the structure is medieval. Fractional reserve banking is the foundation of the modern financial system. Banks hold approximately 10% of deposits in reserve. They lend out the rest. This creates money. If you deposit $1,000, the bank lends $900. The borrower deposits that $900 in another bank. That bank lends $810. The process continues. Your initial $1,000 deposit becomes $10,000 in the money supply through fractional reserve multiplication. The Medici discovered this. Modern central banks institutionalized it. The Federal Reserve operates on Medici principles. The Fed doesn't print physical money. It creates money through accounting. When the Fed wants to inject $1 trillion into the economy, it doesn't print bills. It credits bank accounts. Digital entries. Banks' reserve accounts at the Fed are debited. The bank's lending capacity is increased. Money is created through double-entry bookkeeping at scale. This is the Medici formula applied to an entire economy. The holding company structure protects modern banks exactly as it protected the Medici. When J.P. Morgan Chase bought Bear Stearns in 2008, they bought the assets, but not all the liabilities. The holding company structure allowed them to cherry-pick. When Washington Mutual failed, J.P. Morgan bought the deposits and branches, but not the debt. The structure limits exposure. The Medici designed this 600 years ago to protect against branch failures. Modern banks use it to protect against systemic collapse. Here's what the Medici understood that most people still don't. Banking isn't about money. It's about trust documented through accounting. The money doesn't need to exist physically. It needs to exist on paper, in ledgers, in verifiable records. As long as people trust the records, the system functions. This is why bank runs are lethal. Not because banks don't have money, but because they can't simultaneously convert all ledger entries into physical currency. The trust breaks, the system collapses. The Medici Bank failed during a trust collapse in 1494. Lehman Brothers failed during a trust collapse in 2008. The mechanism is identical across 6 centuries. The Medici also understood that banking creates political power. Cosimo controlled Florence without holding office. He controlled who got loans, who got credit, who could trade. Financial control is political control. This pattern persists. A pledorial reserve, though technically independent, shapes policy through interest rates and money supply. The European Central Bank controls economic conditions across Europe. The People's Bank of China directs Chinese economic development. These institutions have power that rivals elected governments. The Medici proved that financial institutions become power centers. Modern central banks are the inheritors of that model. But there's a darker legacy. The Medici Bank's collapse teaches a critical lesson about systemic risk. Fractional reserve banking works until it doesn't, when confidence fails. When depositors demand their money, when borrowers default, the system has no safety net. The Medici Bank had no central bank to bail it out. Modern banks do. The Federal Reserve was created in 1913 specifically to prevent banking collapses. It acts as lender of last resort. When banks fail, the Fed provides liquidity. This prevents individual failures from becoming systemic collapse. But it also creates moral hazard. Banks take risks knowing the Fed will bail them out. This is exactly what happened in 2008. Banks over-leveraged because they assumed they were too big to fail. They were right. The Fed bailed them out. The Medici would recognize this pattern. They took risks knowing their political connections would protect them. When those connections failed, the bank collapsed. The Medici Banking Formula has 3 core elements. First, fractional reserve banking to multiply capital. Second, double-entry bookkeeping to document trust. Third, holding company structures to limit liability. These 3 elements define modern banking. Every bank uses them. Every central bank is built on them. And every banking crisis occurs when one of these 3 elements breaks. Over-leveraging breaks fractional reserves. Counting fraud breaks double-entry trust. Systemic risk breaks holding company protection. The pattern is consistent across 600 years. The Medici Bank failed in 1494, but the formula they created became the operating system of global finance. When you deposit money, you're using fractional reserve banking invented in Renaissance Florence. When you check your balance, you're reading double-entry ledgers pioneered by Medici accountants. When your bank has subsidiaries, that's the holding company structure Cosimo de' Medici designed to limit risk. The Medici didn't just get rich, they built the architecture of money. And that architecture is still standing. This is what Histofund does. We show you the systems built centuries ago that control your financial reality today. The Medici Banking Formula isn't ancient history. It's the reason your bank works the way it does right now. If this video showed you how Renaissance banking became modern finance, subscribe to Histofund, because understanding the past isn't academic. It's understanding how power and money actually work. Next episode, we're breaking down the Dutch East India Company and how it invented the stock market. Corporate, limited liability, and shareholder capitalism. The first corporation in history, and why every company since has copied its structure. Subscribe now. History isn't old stories. It's the blueprint for everything you see today.